What we expect in terms of growth and inflation for the next 3 months is a positive surprise. On the growth side first, what we expect is the current recovery to mutate into an expansion, so a period of much stronger growth than what we've seen so far. That's the first element that should be supported by an expanding demand. This in itself should be creating a positive evolution of inflation, and that should combine actually this quarter with supply side disruptions that are arising from the pandemic. The combination of that is creating an environment of inflation surprises. We are already gathering evidence of that. That's what you can see on the chart in front of you now. This chart relates historical inflation surprises with the current level of our world inflation nowcaster. That is the indicator that we are following in order to gauge the extent of inflation surprises. From that chart, what you should be seeing is basically that with the 0.5 standard deviation of our indicator currently, which is a red bar, you should expect a 40 basis point inflation surprise. That should lead the current 2.8 CPI year-over-year evolution expected for 2021 into a 3.2% inflation. That is a significant change in our macro environment, and that significant change should be leading to a different investment policy of investors. No, we don't. What we expect is an inflation surprise period that should last both for the shorter term and the medium term. Why do we have such an expectation? Because of the scale of the demand shock that we expect over the next 2 years. A large portion of the fiscal stimulus is currently stocked as savings on the household side and as cash on the corporate side. We expect this money to be spent in the economy within the next 2 years, which will push inflation higher. The chart in front of you shows the historical relationship between growth in excess of trend and inflation in excess of expectations. And when you factor into that relationship the market forecast, if you'd like, of growth, you see that we should see higher inflation. Now, our own growth scenario is even north from the market scenario, which puts us in a position to expect even more inflation. Higher inflation, both for the short term and the medium term, that has one known consequence: higher rates, and especially higher long-term rates. That has a lot of implication in terms of markets overall. This higher rate situation, the rise in long-term rates, should have two types of consequences over financial markets. First, a negative impact on the beta side of markets. We've seen very strong return coming from beta allocations. We do not expect the next 3 months to be of the same kind. And the second impact will be on alpha, and it will open the door to some alpha trades. Let me just expand on the beta side. Any asset paying cash flows basically has a duration sensitivity. That's the obvious case of fixed income products, but it could also be the case of equities paying dividends. Now, our computations are showing that a 1% increase in rates is offset by a 20% increase in dividend. So it takes some capturing of the recovery/expansion that we expect for equities to be delivering positive returns past this point, past today. All of that combined makes us think that we do not expect much from beta, and we expect a lot more from alpha. Actually, this alpha environment is already with us. The chart in front of you shows dispersion measures across sectors and across regional indices on the equity and bond spaces. And as you can see, there is an uptrend in this dispersion measure. The higher the measure, the stronger the dispersion. We expect this situation of a stronger dispersion to remain with us. What does it mean for us? It means that we need to be more selective in the way we invest. We like to be with assets with a positive exposure to growth and inflation. That's notably the case of some cyclical commodities, among which energy, some commodity currencies, among which the Norwegian krona. That's also the case for some cyclical equity indices, Euro stocks and topics. And we try to stay away from the most duration-related securities, which is the case of course for the fixed income world, but not only. We also try to stay away from the most momentum-like equities, such as the tech sector. So we think that higher rates means challenged beta and opens the door to alpha opportunities. We think investors need to get ready for this inflation surprise period by amending their asset allocation in both ways.